Welcome to the Greed Geek Podcast with your host, Jason Fern.
What is up, everybody? Welcome to episode 6 of the Greed Geek Podcast. Today, we're going to discuss how to best build up that nest egg, how to manage your wealth as you approach retirement, and how to keep that inevitable tax burden under control. My guest today is Jason Biance, who, along with his brother Justin, is the Chief Investment Officer at his namesake Biance Financial. Jason earned his BS from the University of Florida. He completed his Master's of Finance degree from the University of North Florida, and his company Biance Financial is a wealth management and retirement planning firm with 4 offices around the southeastern United States. Jason, welcome to the show.
Thank you for having me.
So to start off, why don't you just tell us a little bit about how you got started with your company and what you do for a living?
Yeah, I would say it really kind of started back in high school. I wanted to ask you, did you have Miss Campbell as a math teacher?
I did, yes.
Yeah, she was fantastic. And I think I was in calc class or something like that. And I was at home and I turned on some music and I did my homework. And then like 2 hours went by and I was like, I just need to do math and listen to music because it was kind of timeless. And so I went into finance and I worked for a company for 8 years as a risk analyst. Unfortunately, I'd worked previously. I worked for about a year for a mortgage company, just doing loans. And that was right at the peak. I started there in June of 2006 and I left in September of 2007. So I started as an analyst right when the crash was really getting going. And then unfortunately, it was terrible for a lot of people, but for a young, hungry, analyst, it provided a lot of opportunity. And I got to sit at a lot of tables I had no business sitting at. And I got to learn a lot about institutional investing. And so I did that for 8 years. I held 3 different positions there. And then my brother floated the idea to me, golfing back in 2013. Why don't we start a firm together? He was doing wealth management in St. Augustine, and we started our first office here in Sebring, which I'm at.
Great. And so today, your clients are mainly a little bit on the older end of the equation. Is that right?
They are like 93% of our clients are 55 and older.
Okay. So when you first meet with your clients, I know you go through a pretty intensive kind of consultation with them to understand them really well. What are some of the things that you ask them about?
Yeah, it's a lot of it, at first is, and I think it's important in our business because, we're going to be walking with them through retirement. So we really want to get to know them and we want to see if we're a good fit. Because I think it's a relationship just like anything else. And some things aren't a good fit. And but the kind of blocking and tackling is 5 areas: investment, income, tax, healthcare, and legacy. So all of our questions revolve around kind of where are you in those areas, in investment, in income. What's your timeline? What are your goals? What does retirement look like for you? Obviously, at the end, we go through risk assessment and risk tolerance type, questionnaires, and we have a modeler that we use and whatnot. So it's really just getting to know them. We always tell our advisors, we've got 5 advisors, and we always say you should almost not say anything in the first meeting. Everything should be a question. You know what I mean? This is just data gathering. We will be sharing things in the next meeting. Keep it all about them.
Yeah, I think that's, a lot of people ask me for advice, and it's like, well, advice is going to be different for every person. You have to understand that what it looks like for me isn't what it looks like for you. You may be trying to go to 65. I may be trying to retire at 50. I might be able to stomach the market ups and downs where you might, get too seasick and want to bail out. So we have to understand what those goals are, right?
It is. It'd almost be like everything that if you see anything with our firm, it's all about construction. We have blueprints and walkthroughs and that sort of thing. And I think it's the same. It's like somebody said, hey, I want to build my own house. What should I do? There's some general things I can tell them, right, about square feet, and you want to use this type of plumbing, whatever. But all of the real specifics of it is going to come from their desires, their specific situation, their finances, and all that kind of stuff. And yeah, absolutely. Especially I have a couple of younger clients. I have a gentleman that wants to retire at age 50, and he's a very successful entrepreneur. in a lot of different things. It's one of those neat relationships where I learn a lot from him about business, about boots on the ground business far outside the market. And anyway, so he's very different than all of my other clients, because he's young and he has very high cash flow, and that sort of thing. And so anyway, yeah, it is. It's tailored, it's tailored.
Yeah. So what are some of the kind of balance that you would have, percentage wise? We were talking before the show about bonds, and do bonds even play a role anymore? And I used to hear an adage that you should do like 100 minus your age, and that's how much you should be in stocks, and the rest should be in bonds. But that doesn't really seem to be the case anymore.
Yeah, we're just in a whole new world. And yeah, bonds, they're fixed income. They're meant to look differently. We call those, the way that we categorize everything is based on asset allocation, right? So whatever your portfolio is going to do, the number one driver is what is in your portfolio, what assets are in there. Is it stocks? Is it bonds? Is it, mutual funds? Is it real estate? Is it, whatever it may be? And we categorize them simply in like a house analogy: roof investments, wall investments, and foundation investments.
Okay.
And so bonds are really your wall investments. Okay. You can also, because they're fixed income, you can also put real estate in there. Okay. They're less volatile than the overall market, and they typically have more yield, right, in that regard. And so they're not as correlated to the roof, and your roof is your, index funds and stocks and equities and all that kind of stuff. And then your foundation is your annuities, cash value life insurance, tips, CDs, anything that has some type of contractual guarantee. You've shifted the risk to someone else,
Mm-hmm.
So what happened is those wall investments and like bonds, it's gotten squeezed. It's gotten really, really squeezed. For my clients, right, an alternative for that is alternatives. Unfortunately, for the average investor, there's just not a lot of access to alternatives, because a lot of times they're not as liquid. A lot of them are closed-end funds, REIT type things, and that's how you're able to both diversify and kind of replace that yield that we lost in bonds, right? For the average investor, I would say you just have to look at whatever you're replacing those bonds with. If they're not earning you that much, hey, I want to diversify my portfolio. I want to lower my risk, but I don't want to use as much bonds, right? You have to look at different asset classes, and then you just have to look at how that affects the risk of the overall portfolio, because your overall risk-adjusted return is something that's very, very important to us, right? Especially in the distribution phase for our clients. In the accumulation phase, I would say, let's say who your listeners here, if they're south of 50, they're younger than 50, they're not so worried about risk, right? They're just, I want this thing. I'm swinging for the fences. I don't want any of this, So it's just a different game, in that regard. But yeah, that's a real challenge, especially for retirees. You used to be able to get 3-4% in a CD at the bank, right? Since that's not the case, it has forced a lot more dollars into the overall market, on top of the other dollars that were forced into the market because of low rates, because money chases return, and so it's a dangerous game for older people,
But there are a lot of dividend paying stocks that have a long history of not only keeping but raising their dividends. Like in some of the companies, oil companies, financials, maybe 5%.
Yeah,
or higher in some cases.
And those are great diversifiers, utilities and high, your aristocrat dividend payers and preferred stocks, right, which act kind of like a bond in a lot of ways and stuff. So yeah, those are, again, great alternatives. And then you just have to see, right, adding those in as more of a bond, right, because then your equity portfolio, gets inflated a little bit. You just have to, if you're worried about risk, right, if you're in that season, and that's who I always want to remember, who am I talking to, because they're just two very different worlds.
But is there a reason to not hold those versus bonds? I mean, given, again, like you said earlier, bonds are going to pay 2% at best probably right now, right? So why would I not want to hold on to those stocks? And obviously don't want to put all your eggs in one basket, but why not, right, if they're going to pay that high dividend?
Depending on who you're talking to, I would agree, right? And those are the two phases of investing that I think you always want to make real clear, is accumulation phase and distribution phase. In the accumulation phase, yeah, if I had bonds or whatever, I might as well just be over there in the dividend paying stocks. On the distribution phase, I have to see, if we have market downturns or up creases in interest rates or whatever it may be, will this new portfolio, right, will my max drawdown be worse or better than how they were with those bonds in there? Because it's all about risk adjusted return over here. So so I agree with you for the accumulation. Hey, I might as well, because I'm just chasing yield, kind of, and another, non just growth stock. I want some, some cash flow.
For somebody earlier in their investment career, let's, say the under 50 or even under 40 demographic, how would you advise like value versus growth?
Yeah, I mean, there's a lot of literature on it, it depends on what you're looking at. Are you talking small cap growth? I mean, small cap growth, I think, and then, value over time, though, value does well in a lot of markets.
For example, like, I held AT&T, I just actually sold it, but I held it for years and it paid me a dividend, but the price didn't go anywhere, right? I would be much better off with your Microsofts, with your Googles. I mean, obviously there's some risk there, and they've been punished a little bit lately, but over time, it seems like those are the winners in that kind of phase of your life, right?
In that phase, yeah, I would say your growth is going to be there. Now, I wouldn't boil down value just to like the the character of kind of like AT&T, you know what I mean? Value can also be really great stocks that are just, the earnings per share are just really low. You know what I mean? It's just, there's inefficiencies in its pricing, not necessarily a good dividend payer, but it's just there's inefficiencies in its pricing. And so there's a lot of opportunity there. And you look at, some of these, for I would say younger investor, if you like these things, the Motley Fools of the world, the prudent speculators of the world, like that's what they're after. They're after value, not necessarily just dividend payers, but value. And they have a lot of research behind them, and whatnot. Now, in the end, I hate to say it, the data is just, the odds are stacked against you for stock picking with the majority of your portfolio. You know what I mean? It's just, it's I hate to say it, but I that's something I'd be really, really cautious of people about, with investing.
Right. So that's a good lead into maybe the conversation about individual stocks versus mutual funds versus ETFs, and how you might want to think about what you hold in your portfolio or how much you hold. Right.
Yeah. I think those are all really good tools. I think mutual funds are the gasoline vehicles of investment world. You know what I mean? Like, I think eventually they're just not going to be there. They'll be there for nostalgia or whatnot. There's a handful of amazing funds out there. Don't get me wrong. But I think you have to make a hard argument for most. If I'm looking at a mutual fund or an ETF, I could probably show you an ETF that can do just about the same. You know what I mean? Now, there are, like I said, exceptions. This is not an absolute statement. There's mutual funds out there, and those guys are wizards.
So let's talk about the difference for folks who might not understand the difference between a mutual fund and ETF.
Yeah, so a mutual fund is offered, like, let's just say J Biance Financial. Like we get big and we start our own mutual fund, and people give us money to go invest, and we're going to go. A mutual fund is like a basket of investments, and we're going to go buy stocks and bonds and REITs, and we're going to invest in this way. And then but the thing is if you buy a mutual fund from me, if you want to go sell it, you can't just go out on the open market and sell it. You've got to come back to me, and you've got to redeem it. And it has to be done at the end of the day. And it typically has an additional charge that you're not getting around anymore. So that's one thing when you see these commission-free trades. It's typically not with mutual funds. It's with stocks and ETFs.
And you're also usually paying a higher percentage fee overall, right?
You are. And that's another, it's a very good point, Jason, is like, you have to understand explicit fees and implicit fees. Explicit fees are going to show you, and yes, those are higher, but also the implicit fees, which are buried in the prospectus, are higher too, right? And there's more trading costs. There can also be tax inefficiencies with a mutual fund. And I don't think we need to get into all that, because it really, I think, more so affects a different demographic. But yeah, I'm not saying all mutual funds are bad. By any means, I'm not saying that. I'm saying that I think there's a handful of them that are great. ETFs are the 2.0. And just to explain an ETF, it's another basket. It just tries to mimic an already kind of set group. Like the S&P 500 index fund just tries to mimic the S&P 500, those 500 companies. It's not going to own all of those companies. No index fund owns every single S&P 500 company, but it's going to own the majority of it, and it's going to act like it. that index fund is not, that ETF is not trying to say, no, I think it's going to be, this company, IBM is going to come back, whoever, it's trying to track.
With some exceptions.
There are,
like the ARC fund, for example.
ETFs that are active, absolutely.
Yeah.
And that's where it kind of gets gray and real nuanced, but in general, ETFs can be traded intraday, they're lower cost, that sort of thing. And they have a good track record when you look at the historical data.
Yeah, a lot of the ETFs are managed by algorithms rather than people. Again, not all, like the ARC funds with Kathy Wood, famously not. But yeah, a lot of them are algorithm, and therefore usually the fees are going to be, a lot lower, like a tenth of the fees. And like you said, you can get into and out of it anytime you want during the day.
Also, another good point is minimum investments, right? A lot of mutual funds have really high minimum investments, and some aren't offering anymore,
right,
in the closed-end side.
Yeah, you might have to put in 2,500 or 5,000 or whatever, where an ETF.
Really, you really want to be in the institutional class. I think that's a good point to make there. So if anyone listening to this has a brokerage statement, bring it out, okay? And you're at Morgan Stanley, Raymond James, Edward Jones, and look at that. If you own mutual funds, look at it. And at the end, there's typically a letter, all right? A, B, C, I, Y are the main ones. If it says A, B, or C at the end, it means that there was a load fee or a sales commission at the front end of that. You didn't get the lowest cost share. You want the I's and the Y's. Those are the institutional class. But typically, you have to have $1 million minimum investment. Right. But that's where, and that's where, like, with my clients, because we have an institutional money manager that we're partnered with, my client might come in with, $250,000, $500,000 or whatnot. They don't have $1 million just to invest in that one mutual fund, but it's okay because we're able to access those funds. Those are, if you're in the mutual fund world, you really want to be looking at, I'm not saying every single ABC is bad. I'm just saying it comes with an additional charge. And there's probably another class that is managed by the same guys, right? That doesn't have that charge.
So my general advice for people who are starting out, who ask me, I say start out with a S&P 500 ETF, and then maybe after that add like a total market ETF, and get your base there, and then if you want to, you can start adding some sector ETFs or even adding individual stocks. Do you kind of agree with that as a starting point?
I think it's a general. I would say, I would caution to say that should be the basis for every person. Needs their own investment policy statement. And this sounds real technical, but you need a plan in place because most people are going to get emotional about it, and I think that, unfortunately, I want to caution people, there's this overconfidence in investors over the last, especially 10 years, that they can predict future events, right? They've done well. And that's good. I want people involved. It's just the idea that more than 50% of your portfolio should not be in some type of index. That's a very hard argument. I would argue there's little to no data that says anyone should be doing that, let alone an individual investor. I mean, you look at Dalbar, right? Dalbar always puts out this research. The best money managers in the world 90% of them don't beat their benchmarks, right? So what are they not doing? They're not creating alpha. They're not doing better than you would have done in the overall market of just getting an index fund. So when I hear a lot of individual investors that are taking a lot of their money and going into brand new markets with large percentages of their portfolio, and they're doing well, I hear, right? There's been a lot of, that's great, but it's not a game that has shown the statistics that you can repeat over the long term. So you see what I'm saying? You really, the majority of your money, you really want to just be riding the wave. And then with that minority share, what is a minority share? 1 to 49%, right? How much of that you control depends on the person. I think that's what you were talking about. But I would actually take a step back and say, how much of all this time that I spend on these things, right? If I'm managing a minority percentage of my portfolio, let's call it 30%, right? I've got 70% in an S&P 500 fund, and then with 30%, I'm buying sector ETFs and I'm buying individual stocks. Whatever time I put into that time, I think you want to define, what is that time for me, right? Is it leisure? And I think that this is leisure for a lot of people. It's like golfing. But when I go golfing, I don't bring people that I want to be my client. I go out with my friends and my family, right? It's leisure. It takes my time. It takes my money. But Yeah, well, it was my leisure that, so if that 30% is your leisure, then look at it like that. If it's a business and you're saying, I'm trying to create some extra income for me and my family to pay for things or to remodel the bathroom or whatever, then that money, you need to look at it like a business, right? Or is this my retirement savings, right? This is my long game. This is what's going to provide for myself and my wife, my husband, whoever it is. And down the road, we're going to be okay because I'm worried about Social Security.
Yeah. So I think what I hear you saying is if you're going to invest 10 or 20 hours a week into this, you got to think about, is that time, am I really, by beating the market, if I do at all, by a couple percentage points, is that really going to give me as much return as if I would do something to educate myself or start a side business and then put that money back into the index fund? I think that's what you're saying.
Somewhat, yes, I am. You're right. I'm saying that. I'm also saying, let's say that it's net positive. You put all this time into it and you create alpha, right? My next question is, how long have you created alpha for? And is your system repeatable? Was it not just a timing thing, right? You were in a new industry that had a lot of growth, right? Because if you look at the best investors in the world, they're not traders, right? They're long-term diversifying investors. You look at the David Swensons of the world and the Warren Buffetts of the world and the Ray Dalios of the world. Do you have your shining star stock pickers? You do. You absolutely do. It's a small percentage. It's an even smaller percentage of the individual investor. And I would like, the idea is, I would say, not necessarily, yes, you could put those hours in somewhere else, but, maybe you don't want to because it's fun for you, because it's leisure. You know what I mean? That thing over here. And that's where I think you want to define, like 15 to 20 hours a week. Yeah, I only created 3% of alpha, or I created 40% of alpha, but it wasn't about the money. I enjoy it. You know what I mean? Like that's, but I think that it is that's a fickle leisure time, right? When I make bad decisions in golf, it was a bad day. I'll just go have an extra drink afterwards. You know what I mean?
Yeah.
If I make a bad decision with large sums of money, it's tough.
Yeah, and that goes back to like having those rules for yourself and knowing how much of it you're going to put into that pool versus the 80% or 70% you're going to leave in the index fund.
Yeah. Define your things, and that's where I think it's always, whenever you're looking at any of these things, look at it and then try to take that macro view. Try to take as high level view. Look, okay, well, what is this money to me? What am I doing this for?
With that leisure, there's also a lot of different classes, like how risky people are. I mean, there's traders who are going to be super in and out of stocks, and that's risky. But if I go out and be like, hey, I think that Amazon Web Services, cloud computing is going to eat the world, I'm going to buy Amazon and I'm going to buy and hold Amazon for years. That's probably not that risky, and that's probably not going to require that active. I just believe that Amazon's going to outperform the general market.
Yeah. And when you've come into, we're moving to almost like an oligopoly, right? Just a couple, like I saw this thing in some business journal, and it was basically Google, Amazon, Netflix, and they had everything. They build you houses, they fed you food. You know what I mean? It was only 5 people that they had pushed out everybody out of every market, right?
Yeah.
And they were just the 5. So I think with some of those big ones, you can say, yeah, you can just ride that wave, right? They have so much market share, so much innovation, so much cash. You look at like Apple, I mean, it's insane, right? So they are outliers, right? Because it goes against the ethos of diversification, but they make up the largest percentages of the S&P 500, so I think you always have to have exceptions, as with any data, right? Very rarely is anything absolute. You always have outliers, you always have anomalies, those sort, kind of things.
Yeah. So before we were talking about, people thinking about retirement and maybe the difference in generations. A lot of our parents' generation may have had pensions to rely on. They have Social Security. Mm-hmm. In our generation, we may not have those things, or they may not be there to the same extent. What is your thoughts about that? I mean, is Social Security going to be there, do you think, when we're ready for that age?
That's a $1 trillion question, right? The Congressional Budget Office puts out reports. That's one of the main things I look at. And you don't have to read the whole darn report. You can people, do summaries of them. It doesn't look good. I'm going to be, So the thing, here's what I would say, without being a fearmonger. I would say more so than ever, younger people need to have a very defined, disciplined plan for saving for retirement, because the odds are against you in terms of that. And here's the thing that one thing I don't want listeners of this is discourage trading, and I'm not trying to do that. I'm just trying to put it in its rightful place, right? Yep. And I want it to be part of a bigger picture. You know what I mean? Because people aren't going to have pensions, and we look at things in tax buckets. That's one of the main ways that I look at money. How does the IRS look at money? Most people generate and accumulate their wealth in a tax deferred bucket, in a 401k, an IRA, whatever it may be. Then you have after-tax money. Okay, I put into my 401k or whatever, and then I had additional savings and I invested that. That's non-qualified money or taxable money. Okay, after-tax money. If I make gains on that, I got to pay taxes on the gains, but I already pay taxes on the principal. And then you have tax-free money. And that's the holy grail of investments, right? The Roth account. You can say cash value life insurance can be in here if it's structured properly. You can say muni bonds in certain circumstances can be in here. And so those are the kind of tax buckets. And so that's one of the first things is, am I contributing to all my tax buckets?
Right.
Am I building, not only just a portfolio, but am I a tax diversified portfolio?
Yeah, I mean that's the scary thing to me when I talk to my friends and I ask them, what are you doing? And they're like, well, nothing yet. I'm still young or whatever. I'm like, no, you have to do this now. So when they're getting started, the first thing you have to do, if your employer has matching, take advantage of that full matching, right? Do you agree that should be the first thing you go into?
Yeah, and I would say yes, and I would add one thing onto it is max out their matching, and then a lot of times you can say, I want this to increase by 0.5% every 6 months or a year, right? My percentage contribution can increase, so it's like set it and forget it, and then it's just going to keep increasing, and you're going to keep not missing it, and then so that's kind of one of those yes, absolute things. But I would even take a step back before that. In terms of investing, I would say, number one, you need to get your cash flow management in order, because nothing will happen really unless you get some influx of cash. You sell a piece of real estate, a family member passes away, you sell a business. Other than that, the majority of people that get money to invest, it's from excess savings. Well, there's only a couple of variables there. It's how much I'm bringing in versus how much is going out. I need to have a really, really good understanding on what is going out. And the wealthiest people that walk through our doors, whether it's North Carolina or Florida, it's the people that really understand cash flow management, right? They do not pay for debt. They don't pay for debt. They haven't paid for debt for decades, right? They have positive cash flow, right? Passive income coming in. And so it's really just blocking and tackling a lot, I would say. Don't have any debt. Get debt free, have a savings. The basics of that is 3 to 6 months of expenses. What's 3 to 6 months? If you don't know what 3 to 6 months of your expenses are, to a really good degree, we need $3,000 a month, we need $5,000 a month, we need $8,000 a month, whatever it is. You need to know that. What's your savings rate? What are you always already putting away, and where's that savings going? Is it going to my kids' education? Do I putting them through private school? Do I want to pay for college? Then what about us? I talk to a lot of people our age, right? My sister's age, a little bit older. And they're just like, we've been so focused on our kids, and we haven't done anything, And so by that, the same thing I say is have an emergency fund. The other thing I think is really, really big for people to consider in this stage is before, and again, this is all before we get to investing, because I think it's all about planning and mitigating risk, is if you're a 2-person household, are you both insured in case one of you passes away? And that's a really important thing, because the nice thing about it is you can buy cheap term. You can insure your husband and your wife for not a lot of money on a monthly basis, and that really protects you. That's one thing to consider. Another thing to consider is, do we have estate documents? If we have kids, if we both pass away, I know a lot of young couples like, I do not want my kids being raised by your parent. You know what I mean? And you want to talk through these things. You don't want the courts deciding these things. Yeah. You know what I mean? So those are a lot of planning, blocking, and tackling you can do as a younger person. And then we say, okay, Jason, I'm properly insured. We've got a good savings rate. we don't own anything. And I'm not talking about mortgage, right? Mortgage is a little bit different. It's hard not to have that debt, right?
Yeah.
But still, I would look at it. I would say, are you house poor? I see a lot of people that are house poor. I mean, a house is a house. I would much rather see that other $100,000 go into an investment property.
Sure.
Talk about diversifying a portfolio, investing in actual real estate outside of your primary residence. I think that's something I see a lot of, like, oh, I'm diversified, but all of their equity is in the market in this pie chart. And I would say that's not diversified.
Guilty.
That's all equity. Right.
Yeah. Okay. Yeah. Great. That's great. So you get your insurance in order. You make sure you understand like budgeting. You get your debt paid down. Then you build up your rainy day fund. Now you understand like how much you need for 6 months max of expenses. A lot of people though maybe have done those things, and they have just tens of thousands or even hundreds of thousands, maybe in some cases, sitting in savings doing nothing. Right.
I see that a lot. It's funny. I actually had a guy. He might have been in your class, a couple years older than me, and he reached out. And then I had a buddy who is a friend of mine and reach out, and they both were a little bit tail between the legs. Like, I've got 6 figures sitting in a savings account.
Yeah.
And I would not recommend that.
No, because you're losing money every year to inflation.
You are. And these are the years, your accumulation years, you need growth, especially if Social Security is going to play less of a role in the income that all these things. Now it all still needs, it's all still right, measured growth and kind of the diversifying that we talked about. But yeah, you need to be exposed to the market. And one of the things I would say is, like you said, I think it's great advice. Max out your 401k, and if you can, set it to automatically increase. And the other thing that is you want to consider Roth as a younger person, which is another type of retirement savings account, because the Roth is, if I could put $100,000 in a Roth every year, I would put $100,000 in a Roth every year. Why? Now, I would need to consider taxes, right? I shouldn't make that general statement, but I like the idea of paying taxes today and never paying taxes again. Mm-hmm. I like that idea, especially when you look at the federal government.
Some people listening might not understand the difference between a traditional IRA and a Roth IRA. So can you explain that a little bit?
Yeah, it goes back to those tax buckets: tax deferred, taxable, tax free. Tax deferred means it's not going to hit my income statement. I'm going to get to put that away in my 401k. It's tax deferred, and then all those growth during those years, I never have to pay taxes on any of that growth. And then when I turn, typically you have to be older than 55 or 59 and a half. If I take that money out, now I have to pay the government taxes, and it hits my ordinary income. The Roth is kind of reverse. Instead of it not, I actually pay taxes on my income today, and then I put it into the Roth today. And from that point forward, as much as it grows, as long as I adhere to the parameters, I have to have it open for 5 years. I have to have earned income. I have to be older than 59 and a half when I access it. But when I grab it, it's all tax-free income to me. I don't have to pay the IRS. Now, there's an argument that people say, oh, well, you want to defer taxes until later on down the road, you'll be in a lower income tax bracket.
Yeah.
And I think that there's merit to that, right? But that's running under one huge assumption that tax rates are going to look like they do now, right? That they're holding that variable constant. I don't see a world where that holds true, right? For 2 reasons. One, historically speaking, we're at a very low tax rate environment, historically speaking, and we're printing money like water. Our debt is going through the roof. No one cares about being a fiscal hawk anymore. Inflation, we're flirting with it like crazy. The Fed's actually encouraging it right now. The Fed actually increased there. And so that begs the argument that tax rates are going to be higher in the future. And so when I look at a 401k, that's a tax deferred account. I'm not paying taxes now. I'm not going to pay taxes over the years. I'll pay taxes later. It's almost like having a variable rate mortgage on a piece of real estate you own, right?
Yeah.
And then all of a sudden you go to sell the real estate, and the government says, no. The rate on this, it's not 20%, it's 25%. You don't get as much now.
Well, especially when you're starting young with that Roth, because that money's got to compound. So that growth of your savings then is going to be a lot bigger than what you put in and pay taxes on initially, right?
Could. I would say could. There's a lot of math in there. And what's funny is this is like the, what's the word? Like whenever like whenever people get together, they always talk about that one problem. Whenever you get wealth managers or analysts or CFPs together, this is that, the craziest algorithm. I actually talked to a guy, his name was Jason Graham, a really bright guy, and he had made this Excel spreadsheet. I can't even tell you how many hours he must have spent on it to make the argument for the Roth. Okay. And that's what it was. But yeah, I mean, the Roth, if the other thing that I would say younger people should be aware of with the Roth is, and I should know this off the top of my head, but I think this year, if you and your spouse married, finally, jointly make 186 or 192, something like that, if you make more than that, you can't contribute to a Roth. You made too much, or the phase out starts, and then you. So while you're younger and you're earning less, you have this opportunity to put money into this account, and later on, if you're successful and your income grows, you may not be able to contribute to it anymore. The other thing that could change is they could change the rules of the Roth, the government, because the Roth doesn't work in the government's favor, I don't think, right? Time value of money, I want my dollar today. You know what I mean? Like they say, yeah, well, we're going to push it to later on, but we can change it. We get to change how much we get. It's not, it's not like we're deciding on that rate now. And so that's a game I don't like playing. Now I think you should max out your 401k. I don't want people to think that I'm not saying that. I'm not saying tax deferred is dead. I'm saying diversify your tax buckets. Yeah. Have money in all of them. Yeah.
Yeah. But again, if your employer's matching it, you want to do that because you instantly double your money to begin with, right?
It's free money. There's no that.
Take the free money.
That. Yeah. Oh yeah.
Yeah, and then so there's other vehicles that people can look at, like annuities, and I don't know. I'm sure you know a lot of different ones that I don't know. Is there any other vehicles that people should be looking at or staying away from?
Yeah, it depends on age, right? Again, who are we talking to with the accumulation phase? Annuities, I don't right now, the way that a lot of them are built, because annuities are a contract with a life insurance company, and truth be told, if you lift up the hood and look under them, they're investing the majority of that in long-term bonds. And then they're taking 15 to 20%, they're trading options, and that's where they're getting their alpha. You're based on an index, yada, yada, yada. The day of the old school annuity, right? The old school annuity that looked a lot like a pension, right? I put in a sum of money and then it pays me for the rest of my life. They're still around. There's still income annuities and immediate annuities. Right now they're not as attractive in my opinion, because they're based on bonds, and and they're not really for anyone in the accumulation stage, I wouldn't say, but someone older, yes. Now the thing with older people is they just have to be very careful, because the vast majority of annuities are better for the guy selling them than the person purchasing them. I think there's only, I would say, 5% of annuities in that regard that are good. Life insurance, I think, is a really creative vehicle that people should look at. And I've got some, I don't know if you want to go through that yet, but I've got some books that I would recommend, people that want to learn just about investing and different, thought processes. If you want a different approach to retirement savings, it's called New Rules for Retirement Savings.
Okay.
And it's by a guy named Martin Ruby, and it talks about it's a tax play. It's a really interesting way to look at how wealthy people view taxes and what they're doing, and how you can be doing something similar.
Okay.
Yeah.
So all right, so we got it covered. You get your budget in order. You max out your employer matching. Then you work on maxing out, whatever additional IRA or Roth, both you can do. Now you're left, if you're doing well with your budgeting, you're left with, the savings account that, you don't want to leave in savings. Let's say somebody has $50,000 sitting in savings that is above their rainy day fund. Should they go down and deposit that $50,000 into an investment account, or should they space that out over time, or what do you recommend? Yeah,
unfortunately, it just depends on their situation. You know what I mean? There's two schools of thought. If you think that this is money I don't need and I'm just investing, put it on red and let it go. Time in the market, right? If you look at the data, time in the market is the biggest driver of positive returns, not timing the market. So it's all about just being in the market for the longest period of time to catch that overall wave. It's not about, oh, no, I don't know if I want to go, or go in, go out. Because when you're trading, you have to get it right twice. And not only do you have to get it right twice, you got to get it right twice on every other decision you make for the rest of the times that you trade, right? You got to get it right twice. With investing, true investing, you got to get it right once. You've got to get it right once. You make your money when you buy. And if I'm buying now and I'm going to be in it for 10, 20 years, I'm buying at an incredible.
So you don't think it matters, versus cost averaging versus say, okay, I'm going to put in, this part this month, then next month, then next month. So you get kind of the benefit of cost averaging. Are you saying if you're in it for the long term, that doesn't really matter that much?
It cannot. I'm not saying it's an absolute again. And there's, if you want to, man, what was that paper? The Wharton School put out a really good paper on this. I wish I could remember I'm not going to be able to remember his name, but anyway, the idea is dollar cost averaging is better because over the long term, you're not trying to time the market and you're getting in at different points. And then your average cost basis is better than what you would have gotten if you would have just thrown it in last Tuesday or whatever. That is the one school of thought. And like I said, the time in the market is the other school of thought is the days, if you just miss out on 5% or the top 5 days of any, year, you miss out on the majority of that year's returns. You see what I'm saying? So if this money, if this money is truly long-term, right, I don't need it for anything then I would say you want to consider, both options. You want to consider that because it also depends on the person. It also depends on, because I think that is very, very important in all of this. Behavioral economics, Daniel Kahneman just absolutely paved the way in this regard, is when we're talking about younger investors, we're talking about people that have probably not been in this very long, right? And even if you've been in it a couple of years, this has been a very unique market, and you have to kind of be mindful of how are people going to react when things don't go well, right? You always want to look on the worst day of your portfolio and see how that affected you, your decision making, all that kind of stuff. Because
to your point, another 2007 is going to happen, right? We're going to have this bleak downturn where the market may drop 50%, and a lot of people at that moment freaked out and sold at the exact wrong point in time, right?
Right. And the flip side of that coin, there's a lot of people back in April that were looking for a chance to dump some money, and they did it. I had a guy, an attorney friend, and he was, and God bless him. I was like, great job, man. He had a 6 figures sitting on the sideline. He dumped it in early April, and he paid off, I think he told me 60 or 80 grand of his mortgage. He cashed out in November. Good for you, man. It's going to be a nasty tax bill, but good for you. Taxes are a fine for doing something good, right? Yeah. You don't get taxed for nothing. I mean, it's I do think, there will always be another correction. The thing that I worry about with the GameStop revolution and the Bitcoin revolution and everything like that is you need to treat this like cocaine. You know what I mean? It is incredibly addictive. And I would actually argue that's probably a bad analogy because cocaine only has some, medicinal good things. I think investing has a lot of really good things, but it's gambling. If things can go up, and unless you're investing long-term, a very structured investment policy, you're rebalancing and repositioning as needed, consistently rebalancing or at least reviewing to rebalance every quarter or whatnot. And you got to be void of emotion, you know what I mean? Because irrational exuberance, man, I'm blank on his name too. I can't remember anybody's name. Irrational Exuberance, a great book, professor at Princeton. But anyway, I think that there's been a lot of that over the last couple of years. Unless, last 10 years, if you were really aggressive, hey, I'm going to invest in marijuana stocks. I'm investing in Bitcoin. I'm investing in Tesla. I'm investing in all these tech stocks. Boy, you are riding cloud nine. And I think that's great. You made a lot of money and things are going well. And it's the market, free markets are working for the little guy. I like that. I really, really do. I would just be cautious. You know what I mean? I would just be cautious and look at the data of, am I diversified properly? And have these been kind of timing things, or am I, and then also long-term, what is me and my family's goals? Is it just grow this account as much as possible? Then it's kind of simple. Or, we've got this influx outflow that we're going to need because we want to send little Susie to a really expensive art school over in Orlando, Raleigh, you know what I mean, or whatever. Well, then we need to be mindful of what is this money? You know what I mean? Is it retirement savings? Is it a business I'm trying to make money on to just, help us out financially? Is it my leisure? What is it? And then I think it'll give you good direction of how you should be approach investing this money,
Yeah, realizing we're not all Superman. We're not always going to beat the market year after year. Having those rules for yourself and sticking to those rules, keeping emotion out of it, and mitigating your risk, right?
Yeah, it's easier said than done, right? I mean, it's human nature. It's tough. I mean, I used to trade options, 10 years ago, and I was in my mid-20s. I was an analyst. I thought I knew everything. I just, I finally came to realize, like, I'm working against all the data. All the data says, don't do what I'm doing. You know what I mean? It was that. And so, with the majority, I think if you're in a good index, and then with a minority, you're investing it and spending some time on it and understanding it, like you said, having, an investment policy statement, having some discipline, as long as all that other stuff is in order that we talked about, have fun with it. Mitigate your risk, right? You're only dealing with a minority percentage of your portfolio. This isn't going to affect you and your family, your ability to pay your bills and that sort of thing, because all of those things are taken care of, in that regard. And then I think another big thing is, what is the end goal of this, right? Is the end goal so that I create alpha? I feel like that is the idea of any type of person that is really taking an active approach in their investing. They're trying to create alpha. I can do better than the overall market, right? Than just sticking it in an S&P 500 fund. And you very well may be able to do that. And I would say, if you consistently do that, then what are you doing for 40 hours a week? What's your job? Because if you're not really like enjoying that, and you're good and you enjoy this, maybe you should be putting more, you know what I mean? Like maybe those types of things, or is it, I'm okay at it. I've got some wins, I've got some losses or whatever. It's fun, right? But my business is kind of suffering. And yes, we're in a pandemic and that sort of thing, but should I be putting resources and time into that, all that kind of stuff?
Yeah, I think it's important to note that, but I also think it's important that we communicate to the folks who haven't got started, and maybe a lot of this stuff is way over their head. Like, you don't need to do that. There are very easy things that you only have to maybe pay attention to once or twice a year, and that's it. You go down and rebalance with your advisor once a year. Let it ride until you're ready to retire. Like, you don't have to be active. You'll do just fine with these indexes and with a diverse portfolio.
I think it's a great point, Jason. And somebody might say, okay, well, how do I do that? I really like everything you guys are, and I'm not a trader. It's going to one of these brokerage houses, going to a Charles Schwab, a Fidelity, an E-Trade, a Scottrade, a Robinhood, whoever, and opening up account. Obviously we talked about, should I be opening up a non-qualified account, or should I be opening up a Roth account or a traditional IRA account? Those are just some decisions you're going to need to figure out before. And then I would say, just from my personal opinion, they're kind of almost like a commodity to a certain extent. My custodian, my client's assets are with Fidelity on the institutional side, but that is, as a retail person that's just going to open up a small account, they might like the tools that Robinhood or Scottrade, these different brokerage houses have different tools, and they also, most of them are free commission trades for stocks and ETFs. Most of them are, but you just want to read the fine print, kind of what tools and things that they offer. What's their app look like? That's the beauty of the internet. You can walk through what they all look like and have them sell you, and you can easily start there.
Yeah. So that's a question a lot of people ask, is like, which one should I choose? And I think the message is, it doesn't really matter. I mean, their apps might be a little different. You might like one over the other, but for the most part, they're the same. The difference for me, I chose Fidelity personally because we have a local Fidelity office, and I love to go down there for a checkup once a year, sit with somebody, have them look through these things, say, hey, am I still on track? What do I need to do? How should I rebalance? That is invaluable to me. And maybe that leads me to a question, like, when should somebody go see you or somebody in your business?
Yeah. I would say, typically I would say for someone that and I don't want to say in my business, because There may be a Morgan Stanley or a Raymond James or an Edward Jones guy that's doing what I'm, a financial advisor, and they say, no, the young people need to come see me. And I would say, yes, I would say blocking and tackling the things that I talked about and putting a plan together is really, really important. But a lot of that you can do on your own as a younger person, because, once the plan is in place, it's more about the day-to-day, just cash flow management, especially like if we're talking about a person that's just going to, they don't want to trade, they just want to invest, and they just want, it's a somewhat set it and forget it thing. You know what I mean? As long as you, the client, are doing the other things with cash flow management, protecting yourself, having your state documents in order, God forbid something were to happen to you or your wife, or your husband, or whatever. But what we are is we're retirement specialists. So I'm there to make sure when you finally say you're going to retire, when you finally pass away and your spouse passes away, you don't run out of money. And that's where getting the plan in place ahead of time, I would say 50 is a good time. A lot of people, when they're younger than 50, we say, hey, here's some tips, here's some tools, come back and see us later, when you're later. I do have some younger clients, like I said, the example that I gave, and it's when it's really high income earners. When you have people that have $100,000 to $500,000 of free cash flow at the end of the year, they need help investing that, right? Because if you generated that much free cash flow, you don't have a ton of time on your hands. Right? You did something to generate that. And so that's where I come in for younger clients. My younger clients are just the ones that have really high cash flows.
Cool. Last question I have for you is, so you, in these, I have a brokerage account, which is the money that I invest. That's not in my retirement account. So it's not any way tax deferred. It's not a Roth. I've already paid taxes on it. And I also pay taxes on the gains. The challenge that I have, and I don't know if there's any way around this, is when I do want to rebalance, it's so hard to rebalance because I have to pay the tax bill. Like if I want to get out of some tech stocks and put some more into utilities right now because of the way the market's playing, I feel like I can't, because if I sell that Microsoft, I'm going to have to pay a huge tax bill on those gains.
Yeah, you bring up a great point, Jason. It's tough. It's tough with non-qualified investing. Yeah. And I think it's something that is really something good for your listeners to be mindful of, for that brokerage account, that non-qualified outside of a retirement account, is, when you have those, and especially like in a year like last year, like let's say you were part of the Tesla ascent and you sold, late in the year, that's going to hit your, if you bought it and sold it in the same year, it's a short-term capital gain. That's going to hit your ordinary income. It's not going to hit your capital gains rates because it's not long-term. So then that's even another nuance is whatever I'm selling going to hit my ordinary income, or is it going to hit my capital gains? I still got to pay the IRS either way, but you're right. It is a tough balancing act. And then, with my clients, we're always looking, in terms of taxes, of course, a lot. But, because in terms of their taxes, if their income goes up too much, their Medicare gets more expensive, and more of their Social Security is now taxed. And, there's this cascading of tax things that happen. I don't think younger people have as much to worry about, but yeah, that is a predicament of a younger person.
I worry about some people not realizing, even especially the short-term gains, right? If they're new to it and they sell it like, cool, I made $10,000. Well, did you? Because you're going to have to pay 25, 30% of that back to the tax man.
Yeah.
Be careful. So short term is anything under a year, correct me if I'm wrong, and long term is your gains if you've held it for more than a year, correct?
Yeah. Yep. Mm-hmm.
Yeah. And so that's a huge, what is the swing? So the short term is ordinary, whatever your ordinary income tax rate is, and the long term is what's the capital gains rate?
0, 15, or 20. Most people are going to fall in the 15.
Okay.
15% tax bracket. Yeah. So you have to make a very low income. And if you had a big capital gain, you know what I mean? Like to be in 0, most people are going to be in the 15%. And then it goes all the way up to 4 something. I don't know off the top of my head, but yeah. So most people, they're going to be in the 15% capital.
So yeah, be aware of that. I lied. One last question I want to ask, in a similar vein, anything you can tell us about tax loss harvesting that might benefit people?
So just to, excuse me, fighting a end of a cold. Yeah, tax loss harvesting is you would have had an opportunity of it. It's basically selling losers to offset some of your gains. So, at the end of the year, if you have a lot of money in a brokerage account or a non-qualified account, and it was a good year for you. You kind of get that like, I don't want to go speak to my accountant, or I don't want to do if you do your own, TurboTax, I don't want to go see, you might, oh, well, if I've got some kind of laggards, I could sell those, and then I can I don't have to owe Uncle Sam as much. And it's great planning. I do it for my clients. That is one of what you're talking about is a biggie, more money, more problems, right? If you have a lot of non-qualified money, you got problems, you got tax problems, and you need to be nuanced. And I think that's a great point that you bring up. Tax loss harvesting is a way to make the tax laws and the timing of the buying and selling of things work in your favor a little bit more. And I think that's probably the best thing that a lot of investors and young people and anyone in general can do is just understanding the environment around you, so that you can kind of see those things a little bit better. Oh, if I do this, wow, that really helps me.
And it's the way to make an opportunity out of the market right now. The NASDAQ has been pretty punished, and we're seeing a lot of red. But we can make some opportunity out of that by canceling out some of that gains. And for example, if you had Facebook, right, and you lost quite a bit in Facebook, where you can sell Facebook, immediately turn around and buy Amazon, that probably is similarly punished. You get to write off your loss in that Facebook stock while you've just moved it into something very similar at the same level. So when it does come back up, you enjoy the gains from that, but you've saved a little bit on the tax dollars.
Cost basis. Yeah, absolutely. Absolutely. I will say, if I think, and of course I'm biased, but my brother Justin is my business partner, and he just released his second book. And I think it does a really good job. Obviously, like I said, 92, 93% of our clients are older, but I think it's got an incredible amount of information that's good for everyone. And so
what's it called?
It's called Designed to Last, Renovate Your Financial House, and have confidence in retirement. But if you just go to retirementdesignshow.com, so it's a retirementdesignshow.com, and you can put in your information and get a copy of his book. What I like about it, and like I said, it gives you a good lay of the land in terms of planning, in terms of where investing fits in, how taxes fits in, how risking. Like I said, you may read some of this. If you have some younger listeners and they get the book, and be like, oh well, this is talking about legacy and leaving things onto my grandchildren and all that kind of stuff doesn't apply. So there's some of that too, but I think it's a really, really good, like I said, lay of the land for someone who wants to just learn more about investing.
Sounds good. Hey, I appreciate your time. Jason Biance from J Biance Financial. Thank you for joining me.
Yes, thank you, Jason. You take care.
Everybody, remember, start early, be diversified, and stay greedy. We'll see you next time. Don't forget to subscribe.
Follow Greed Geek on Twitter and Facebook at Greed Geek, and follow on Twitch at Greed Geek TV.